Welcome to our virtual NAIOP Southern Nevada breakfast meeting. We're pleased that you're joining us this morning to hear our experts speak on where we are in the commercial real estate market today. Before we get started, I'd like to take a minute to remember a dear colleague who passed away a week and a half ago. Eric Reich joined NAIOP 5 years ago, but you would have thought that he had been a member much longer than that. He was a man of many talents and was always one of the first people to volunteer no matter the task. Eric was an active member of both the Golf and Spotlight committees and was the current chair of the Community Services Committee, which, if you knew Eric, suited him perfectly. He was especially proud of the renovation project at St. Jude's Ranch for Children that he helped direct. Let's continue to celebrate Eric the way he celebrated life, with passion and with purpose. At this time, we'd like to thank our President Circle sponsors who were so instrumental to the success of our NAIOP chapter. Thank you to our Platinum sponsors, Cox Business and the Howard Hughes Corporation. We also want to thank our Gold sponsors, DC Building Group, Kinley Horn and Associates, Majestic Realty Company, Panattoni Development Company, Prologis, and Thomas & Mack Development Group. In addition, we'd like to recognize and thank each of the remaining levels of our President Circle sponsors. Thank you to our meeting sponsor, Commercial Alliance Las Vegas. They've been a valuable supporter of our chapter since 2010. At this time, I'd like to introduce Robin Sivish. Robin is the 2020 President of Commercial Alliance Las Vegas and an Executive Vice President at ROI Commercial Real Estate. Fun fact about Robin, she worked with NAIOP's Jonna Savage in the late 80s at Miller's Outpost in the Meadows Mall, when the Meadows Mall was fairly new and kicking it, which goes to show you, you never know when you're going to cross paths with someone from your past. Welcome to the program, Robin, and thank you for your support.
Thank you. Good morning, everyone. So for those of you that don't know, Commercial Alliance is CLV. And as an organization that brings our industry together, CLV is proud to sponsor today's breakfast program. If you're not familiar with Commercial Alliance, it's the commercial real estate division of the Las Vegas Realtors, formerly known as GLVAR. We've grown to become one of the largest organizations in Southern Nevada for commercial real estate professionals with over 560 members. Our mission focuses on education, networking, promoting professionalism, and shaping public policy. And we will be hosting a webinar on the 21st at 10 a.m. with the Nevada Treasurer to discuss the $20 million in rent relief. So please tune in to that. We also have educational opportunities, and we will be presenting a great one on July 31st with our virtual version of our next Commercial Education Day. The classes will be held from 9 a.m. and another one at 1 p.m. via Zoom. The cost is $10 for Commercial Alliance members and $15 for non-members. And note, these will count towards your live CE credits if you renew this year. The 9 a.m. class is on July 31st is commercial contracts and 1031 exchange issues. And the second class is at 1 p.m. and will be on small business administration, 7A and 504 loan programs. And to find more information on not only Commercial Alliance and the classes, go to www.calv.org. And thank you very much for having me today.
Thank you, Robin. And thank you again, Commercial Alliance Las Vegas, for sponsoring today's meeting. We'd like to thank all of our 2020 meeting sponsors: Affordable Concepts, American Nevada Realty, Carpenter Sellers Delgado Architects, Commercial Alliance Las Vegas, Cox Business, Helix Electric, NV Energy, and Roofing Southwest. We're also very excited to welcome our new members that have joined in the last month. I hope that if you're not a member, you'll consider joining our organization. We are 573 members strong, and even during these uncertain times, we've continued to network and connect with each other through principal forums and committee meetings, presented critical information our members can use through our breakfast and education programs, and strengthened our relationships with other organizations as we've tried to navigate through this pandemic. You can join online or call 702-798-7194. NAIOP Corporate continues to offer the complete library of on-demand courses at no cost to members through August 1st. Most courses have 90 days to complete, so if you register by August 1st, you can still take the course. Members can log in with their member ID to see complimentary pricing, and no code is required. NAIOP's membership guarantee promises to extend your membership for a full year or until you're employed for anyone that has lost their job. Be sure to reach out to Katrina or Jana if your contact information is changed. Some exciting news. 20 individuals have been selected as the recipients of the 3rd annual NAIOP and Prologis Inclusion in the Commercial Real Estate Scholarship for Women and Underrepresented Professionals. The program is designed to prepare a pipeline of women and minorities for development and operations positions in commercial real estate. Congratulations to our own Mariana Honeycutt of Kimley Horn and Associates. Congratulations, Mariana. And now I'll turn the time over to Jim Slack, DC Building Group, for a few committee announcements.
Thank you so much, Julie, and good morning to everybody. Just a few announcements. The Community Service Committee is holding an online fundraiser for communities and schools to help graduating seniors with college application fees to the end of July. A quick reminder that NAIOP has a members-only Facebook page. It's a great place to get connected, stay informed, and try to post some videos. It'd be great to see what everyone's been up to throughout this pandemic. Although the annual bowling tournament was canceled, the social committee has been busy planning a members-only trivia tournament. Watch for details, as you won't want to miss this one. This year's NAIOP National CRE Converge will be held virtually this year on October 6th through the 8th. Check NAIOP's website for more details. Our 2020 bus tour is also virtual. Save the date for Friday, November 6th from 8 to 10 a.m. A reminder to email your property submissions by July 31st. Check your inbox. The 2020 NAIOP Annual Golf Tournament is still planned to be held Thursday, November 19th at Spanish Country Club. And finally, we'd love for everyone to engage in social media today. So please be sure to tag @NAIOP SNV in all your posts. Julie?
Thanks, Jim. We're honored today to hear from 3 of our members that are well-versed in office and industrial development. I'd like to introduce Owen Sherwood, who will moderate today's program. Owen is an Assistant Vice President of Commercial Sales at Fidelity National Title Group, National Commercial Services, Las Vegas. He works closely with all commercial real estate stakeholders to coordinate and close real estate transactions across the nation. Fun fact about Owen is that while growing up in Las Vegas, he and his best friend almost had their caricatures placed on the wall of famous celebrity guests at the Palm Steakhouse and Caesar's Palace. You were so close to fame, Owen. What happened?
You know, I just couldn't quite get all the way there, but trying in real estate to make my way now rather than get up on the wall of a steakhouse. So.
Well, you're a hero in our book. Take it away.
Well, thanks so much, Julie. And, you know, before I introduce our esteemed guest, I just want to say how grateful I am to NAIOP for kind of keeping this forum alive for us all while we've been going through this incredibly strange time. And it's been a wonderful connecting force. And I'm really grateful to have NAIOP here. So with that said, I'm really excited today to be talking to these 2 gentlemen. I get very excited when we have a broker panel because I feel like we can get in and dig into the market and really get an understanding of what's going on. So today we have with us 2 just wonderful guests. Dan Doherty is the Executive Vice President at Colliers International, and he focuses on industrial for those of you who are not aware. He's been in the business for 31 years and has done some incredible things along the way. So one fun fact about Dan, and I don't know if I'm going to say this right, but he has fly fished in eastern Siberia, which is in a peninsula in Russia, named Kamchatka, where some of the world's largest rainbow trout exist. And I do want to know from Dan, what the biggest fish he's ever caught was. I think that would be interesting to know, given that he's been to this interesting area.
Biggest trout on that trip was only close to 6 pounds, but there were a few more able fly fishermen on the trip that caught a couple close to 10. So a 10-pound rainbow trout is something most people in the world don't see. I didn't catch one, but I did get to see a few.
Wow. Well, fascinating. So without further ado, we also have Ryan Martin on the panel today, and Ryan Martin is a Senior Vice President at MDL Group, and he has been in the office sector for about 20 years and brings to us a great level of experience. And, since we're doing the fun fact about Ryan is over the last Thanksgiving break, he and some friends planned to go skydiving. The initial jump that was planned got canceled due to rain and wind, but he still, mustered up the strength to go do it, and he ended up making the jump. So, Ryan, what was that like? Was that scary? Are you a thrill seeker? I don't know that about you, but what was it like?
It was, it's hard to describe. It was a little terrifying knowing the day after the weather wasn't permitting. So the following day we went out there, and I guess all I can say is once you get in the plane, there's no turning back. And it's just that easy. You're going out of that plane with that guy no matter what. So highly recommend it.
Well, glad you're here to tell the tale. So without further ado, I'd like to get into it, and I'm going to just start by setting the table with some numbers that Dan and I emailed about yesterday. So let's talk about where we're at in the marketplace. So in Q2 2019, we had 1,236 total sale transactions in the commercial real estate market. If you exclude land, that was 518 commercial real estate sales. And in Q2 of 2020, just to see how we compare from a year ago to today, we had 985 total transactions. And if you exclude land, we were at 318 total. So we're looking at technically a 40% dip in overall volume of sales transactions. So with that said, Dan, maybe we'll start with you. Where are we at in the market today? What are you seeing?
I'm off mute, right?
Yes, sir.
So we just released our second quarter report. So the few stats I'll quote, not too many, are as of the end of June of this year. So this is kind of what I call a static perspective. So it's a snapshot of the market, and the snapshot is pretty healthy on the industrial side. Absorption year to date through the second quarter is 3.2 million feet. That's higher than this time last year, surprisingly enough, where we absorbed 2.9 million square feet. So about a 300,000 square foot increase in net absorption today versus this time last year. Still building close to record levels of new supply, with 2.6 million feet completed this year, again compared to 2.9 million square feet completed this same time last year. The supply in the second quarter, we ended up stripping out almost 1.9 million square feet because the project simply didn't get done by the end of June. So we only completed just under 800,000 square feet in the second quarter, but we will complete over 4 million square feet of new industrial buildings in the third quarter. So third quarter still has its strong level of supply, but we pushed a bunch of projects that did not get certificate of completions in the second quarter into the third quarter. So it's important to note, and we're keeping our hopes high that vacancy or occupancy remains strong, because we're going to complete well over 5 million square feet of industrial buildings in the second half of 2020. Vacancy did kick up a little bit, just over 5% in the second quarter. So it's important to note that that is the 5th consecutive quarter of increasing vacancy. Most of those quarterly increases in vacancy were slight and they were due to strong levels of new supply, not necessarily any problems on the absorption side, with the exception of second quarter. Second quarter is the first time we're starting to see true results of the pandemic. And we saw negative net absorption in 4 of the 8 submarkets we track. From a product standpoint, we saw minimal amounts of absorption, albeit positive, in flex and incubator products. So kind of more mom and pop stuff, as you could imagine, getting hit harder than bigger regional, national, and international companies. And all of this on the product side was kept afloat by 3.4 million square feet of net absorption and warehouse distribution, which I think most people would kind of nod and say that makes sense. So the big fulfillment centers, the big occupiers, the strong companies obviously are faring much better than the local companies, which is a pretty similar situation to what we saw in the GFC in 2008, 2009, 2010.
Ryan, how does that compare with what you see on the office side?
Well, first, thanks for having me. I think it depends on a little bit of, what part of the office market we're talking about. And what I mean by that is, are we talking about Class A? Are we talking about owner user, woody walk-up type construction? Are we talking about fulfillment centers and call centers and back of the house sort of things? Depending upon, kind of what lens you want to talk about there, I would say overall things have kind of hit a pause button. Over COVID, I don't think it's any surprise that everyone's kind of just cautiously looking around, trying to figure out what's going to happen, especially in the office arena. I don't think there's been any major resets or anything yet. We're not seeing any types of, huge subleases coming out to the market. What we are seeing is a lot of evaluating, a lot of purposeful thinking, and a lot of just intentional kind of circling the wagons if people had that luxury. But overall, I'd say just statistically, from where I sit, I think that it was a little bit of a slow second quarter. I think your numbers represent that. I think the deal volume was a little bit smaller, generally speaking, in terms of the dollar amounts. But I do think that where I'm sitting, we've entered a lot more escrows. And I think a third and fourth quarter is going to be stronger than what you've seen thus far.
What have both of you seen on the rent side? I mean, we hear about forbearance processes and landlords negotiating with tenants because of certain closures, and that may have been less impactful potentially on the industrial side, but is that impacting the industrial and office markets at this juncture? And are you hearing about tenants asking for rent reduction, or are newer deals getting done at lower rates than we were looking at a couple months back? Where do you guys see that going? And I'll leave it up to whoever wants to jump in first.
I can jump in there real quick. To answer your question, I haven't seen any compression on rents at all. Doing deals with Blackstone to out along the Beltway, I haven't seen any compression. All my landlords are still fairly bullish. Their product is right. Their vacancies are pretty healthy in the sense of not a lot of vacancy, 1 or 2 spaces available. So we haven't seen a tremendous amount of compression yet on rates. I think the PPP program really helped a lot of us office users. I think that allowed a lot of people to kind of get through this time. I can say from a property management perspective, from MDL, we managed close to 13 million square feet. I think the average collection last month was about 85% in rent. So, I know on some other calls with some other landlords, they're ranging, depending on their portfolios, from 75 up to about 90% collection. So thus far, as much as the COVID seems to, put a damper on things, overall, I still think it's pretty good.
So from an industrial standpoint, it's important to acknowledge the difference between coupon rents and net effective rents. So I think everybody knows coupon rents are simply what you advertise on a given property. And I haven't seen much change in coupon rents. We have lowered a few B and C properties to be a little bit more competitive with the massive amounts of new construction. But by and large, coupon rents have remained the same through the second quarter. Net effective rents are changing. So you're seeing higher concessions with regard to free rent. We've done some deals with 10 months free rent, which made perfect sense on a newly constructed project where a tenant took an entire building that we planned on breaking up. That was a Matter project on West Cheyenne, so we saved a boatload in TIs by not cutting up the whole building. We had 15 months of absorption for the project, so to give the tenant 10 months of free rent made perfect sense. You are seeing higher amounts of TI dollars given to tenants. You're even seeing more concessions on renewals. So typically what happens in a downturn, which sometimes I wish I was back in my career when I hadn't seen a downturn. But this is the second significant downturn I've seen in 31 years. The first one kind of happened when I was just getting going in the business in 91, when the first Gulf War, 92. But the first thing you see is concessions. So that's kind of what I call under the table stuff. So here's the rent, here's the lease comp, everything looks good, I got my rent, and then you look below or into the body of the lease and you see, well, wait a minute, you didn't quite do the same amount of annual escalations you typically do. You gave an above standard TI allowance. You gave a little more free rent than you did on your last two deals. So those are just the beginning stages of what we see to make the connection between supply and demand. And as time goes on, if this virus continues to drag out, you're going to see more of a shift where concessions aren't getting it done and potentially more of a slip in coupon rents or asking rents on properties. And obviously it's too early to tell if that's going to happen, but I think most people would think that this virus is going to get certainly dragged out more than I thought it was going to 45 days ago.
That coupon rent you discussed, would that have happened if COVID was here or not? The 10-month free rent?
I don't think so. The reason I delay on the answer is because, again, it's a brand new project. It's 727,000 square feet. So there's, we're still 2 months from completion. So to be doing deals during construction is always big upside for a development group like Matter. The demand is continuing to grow for that project. So what I should probably say is I'm not sure. To me, the deal kind of made sense on its own, pandemic or no pandemic. There is just a little more sense of urgency, especially on the pre-lease side, to knock out some of that space before you deliver the project.
So as we sit here today, I guess the one thing that I would comment on as it relates to that sort of stuff, I have anecdotally heard from clients, brokers, and folks in the industry that in the apartment sector, they have been generally somewhere in the 80% collection range, some properties higher, some properties lower. I think the retail sector is probably all across the board. It's different depending on where your property's at and what you're dealing with. There's some real nice centers I've heard that are doing great. There's others where I've heard that national tenants are some of the first to say we're not going to pay. So it seems to be across the board very, very different. But so, with what we've talked about, we're now out of Q2, and it's interesting because things are different than they were in March. We're back open for business largely, but the virus is having more of an impact in communities as people are out and about. So what do you see the rest of Q3 looking like, and how are we going to round out this year in Q4? Do you feel like we're going to finish strong? Is activity increasing? And I'll ask a question and then talk a little bit more, but anecdotally, we have bounced back a little bit from, bouncing back isn't the right word, but we've maybe improved the amount of escrows that are coming into escrow and deals that are closing. in June over what we saw in April and May. And so far, July is having some consistent activity as well. So I'm hopeful that, we're going to increase activity, but what do you guys see for the remainder of the year and how we finish out?
Go
So
ahead, Dan.
the information I talked about kind of to date, again, just a snapshot of the market, static versus fluid. The market is anything but static. It's constantly changing, and there's events occurring kind of behind the scenes that shape the future. So there's a lot of negative things happening right now, and I'm going to talk about the positive ones as well, but let's get these out of the way, because some people say you're too negative when you talk about the market right now. And the reason that I try to focus on that a little bit is because I believe in what we call appropriately advising. So if you're telling your clients everything is rosy, absorption's good, vacancy only went up a little bit, how is that client going to be equipped to make the next deal that they probably should be stretching to make? So we've seen a pretty substantial increase in tenant defaults. We're handling 7 to 8 spaces for several different landlords that we would not be handling if it wasn't for the pandemic. So these are tenants that simply walked into the landlord's office and handed back the keys and said, hey, I cleaned it up as best I could. I'm done. We've seen a 380% increase in the amount of sublease space in the market in the last 90 days. And we're tracking that on a monthly basis. So thankfully in June, it didn't go up very much from 933,000 square feet to 957,000 square feet. But that's a much more significant part of the available inventory than we've ever seen. And so that's something you have to pay attention to. In a normal market, 4 months ago, if you could believe it, we didn't even really look at sublease space because it was minimal amounts, 170,000 square feet. And tenants really didn't like to focus on it because you always had to do a shorter term. There were no TI dollars. Even though you could get a little break in the rent, you just didn't get the kind of space you wanted and the lease terms that you wanted. Now it seems like the sublease space is becoming much more appealing to occupiers, again, because of that shorter term that everybody seems to be a lot of people seem to be focused on right now. You're going to get a below market rent, and you'll probably be willing to take the space that's not quite perfect for you because you can save some money. So we're really focused in on sublease space, make sure that doesn't continue to grow. The tenant defaults, in some cases, again, if this thing drags out, will start to lead to loan defaults. If you're only capturing 70% of your rent roll for an extended period of time, it gets real tough to continue to pay debt service. So we will see some issues with loans on the industrial side, but you'll see the lenders react much differently than they did in the GFC. Instead of moving immediately to a foreclosure with somebody handling it out of the East Coast, it'll be more of a relationship event where there'll be a workout strategy some are talking about already. So I think the lenders learned a lot from the great financial crisis we had, and they won't be in such a hurry to take possession of that property. They'll do everything they can to try to work it out. The other thing that's happening is you're starting to see a lot of these government subsidies and kind of these artificial support mechanisms in place disappear. And if they get extended, whether it's PPP, whether it's another stay on evictions, you'll see everything move down the road for a period of time, hopefully into a better climate, but we don't know. So as these artificial supports start to evaporate, that's when what I say the rubber is going to meet the road. That's where we're going to start to potentially see more negative events occurring in the market. Now, I said I would touch on the positive, and I'm probably speaking too long, but take a look at unemployment. When we started this, we were somewhere around 4%, and in less than 40 days, we went to 33% unemployment. Our Review Journal article just came out, and it's already back down to 15%. So I think we have 93,000 new jobs, primarily in the gaming sector, which brought unemployment from 33 to 15%. Now, 15% is still almost 4 times what it was pre-pandemic, but it's a heck of a lot better than it was 2 weeks ago. Hopefully, as gaming or casino occupancies and gaming revenues continue to stay and get more healthy, that unemployment number will come down as more people go back to work. Logistics, I'll touch on that in a little bit, but that's changing dramatically. We're expected to see over 1 billion square feet of new occupancy in the next 4 years in the US. Vegas will get its share of that. And the reason I'm confident about that is we're getting a lot of calls from California companies. We're getting a lot of calls from companies in other parts of the US that are in very dense environments, and they view Vegas as a much less dense environment from an operational standpoint, as well as living standpoint, because we have so many suburbs in Vegas. And you're seeing that in beach cities, you're seeing that in mountain towns, big demand on people trying to escape density because they think either this is going to drag out longer than expected, or we're going to be dealing with another type 12, 24, 36 months from now.
I want to quickly remind all of our attendees today to use the Q&A function at the bottom of the screen. If you do have a question, we would like to hear from you. We're going to take some time towards the end of the panel today to go through some questions and try to get to your individual questions. Ryan, I want to get your take here on what you see. And Dan, thank you for all of that. You know, love when Dan talks, because it's just, you know, a stream of consciousness, and there's a lot of wisdom in there. So I appreciate all that you had to say. Ryan, what's your take on where we're headed at the moment?
Again, I mean, I think I agree with a lot of what Dan said in terms of it's going to spill over to whether it's office or industrial, the unemployment factor, you know, cost of living, Las Vegas in general. I agree with all the statements that Dan was stating. We haven't seen as big of an impact on the sublease as Dan's seen on the industrial side. You know, some of the projects that were getting ready to break ground had the luxury of kind of hitting the pause button, reevaluating some of their plans, and I think that was great. I think, you know, we mentioned Matter, we've mentioned like Lepore Narrative, Samsung's building a building. There's a lot planned in the office sector too, and I think all of that's going to move forward. I think that all gets built. I think that, you know, in talking to like Jeff, you know, they're going to like touchless elevators. They're expanding, you know, everything's going touchless in terms of restrooms, lobbies, temperature readings in office buildings. And so with all of that, you know, I think that in some aspects where the office market was and where we were kind of dragging behind in terms of brand new development, in terms of speculative development, we saw a lot of build-to-suits over the last few years. But, you know, just recently where we've seen speculative office development, and I still think we will see that. I have plenty of confidence in those developers. You know, a lot of it's been pre-leased. You know, just bringing up Jeff again, Narrative's at 70% already pre-leased. They haven't broken ground. So, you know, from those aspects, I think those that know what they're doing and we're really good and pros at it. I think the market is scary. Yes. I think COVID has thrown us on our side. I think a lot of people are working from home. I don't think we even know what we're dealing with from a lot of aspects, but I think it's too early to tell. I think a lot of the office, you know, users that I'm talking to that have a huge density of like people in cubes, those employers have sent their people home if they can, and most of them can send them home at the moment. It's not foolproof, and it's not going to be the trend of the future, but they might be incorporating a day or two a week into that. The other things that we're seeing is a lot of analysis on, you know, what used to be an open sea where you could see across rooms. Do they lift panels and create higher cubes and all of that? The fact of the matter is everyone's evaluating it. No one's willing to put out the capital yet to go do that. Meaning they might have their vendors pricing those things out, but at the same token, they're kind of stalling because they don't know if that capital infrastructure is really needed in the event that a vaccine is, you know, produced this year. On the flip side of things, we're setting record pricing on owner-user office buildings. I'm entering into escrow at $290 a foot for a shell building. I have 4 other buildings at $265 a square foot in escrow. And you know, the TIs these days for these types of office users from ground up construction are $90 a foot. So we're still seeing quite a few people that are very good at what they do, whether it's in the medical arena, law, architectural. They are still, like you said, cash is king, keeping their powder dry. A lot of the companies weren't over leveraged. They learned from this last recession. This pandemic is a lot different. It wasn't because we were foolish about finances and things like that. And the PPP, I think, has really helped. I think it will be something to watch in terms of if another rollout comes or how that impacts, you know, future rents, especially with the eviction moratorium being lifted just recently. But I think, again, what we're hearing from most tenants on the office side is that they're making their rents. They're not too many are defaulting, and the ones that are defaulting are the big boys, the ones that can play the game, the ones that have the resources to send in the notice from their legal team saying, hey, we're not paying rent this month. I've only heard of a few, you know, call centers that are considering talking about giving back some space, but that was almost pre-COVID anyways. They were evaluating their operations and, you know, deciding whether or not to go that route. So it really depends on who you are, but I do think that overall, I'm fairly optimistic. Even with the unknown of COVID, I'm pretty optimistic on Q3 and 4.
So I want to kind of piggyback on something Dan said. I was walking into the office this morning and one of my national underwriters was here and we were kind of chit-chatting about this panel today and what's going on in the overall market. She told me that, and this is anecdotal at this point, you'd have to go Google it and find the numbers, but she told me that we're nearing throughout the country commercial and residential defaults that are near what we were before the great financial crisis. And that is a little alarming to hear, but I do believe in my conversations with servicers that we're not in a rush to take back these properties at the moment. And there's a sentiment for sure that whether you're a bank or even a servicer, and the servicers were typically much more rigid, that, you know, a bird in the hand is better than 2 in the bush. And you know, if we can get some cash flow out of this property and not rush to throw it out on the market, maybe perhaps we can have a better situation and get this going quicker. And that has such a macroeconomic effect, because if these lenders were to take back all this stuff, it immediately goes to distress, and you know, the property becomes dilapidated. There's trouble that happens there. And that dovetails into the idea that we have at the moment. I think there's a lot of sentiment from an investment sales and value add standpoint that because COVID is going on, there should be some inherent discount in the marketplace. And, you know, I want to dovetail into the investment sales conversation and pricing. I don't think, from what I see, that we've started to see any real discounts when it comes to investment sales just yet, or the value add properties that folks are looking for. And I know industrial has been relatively hot still, and office, you know, Ryan, you talked about the owner user side being very active, and I could say I've seen that as well coming into escrow. It's been, whether you're talking about refinances or active sales, that is a very active part of the market. And I think, you know, got our company through April and May, where investment sales lagged. So what are you gentlemen seeing on investment sales at the moment? And I would, maybe not to steal the thunder, but we saw that, you know, Van Trust developed that wonderful building out in the Northeast that Amazon took over. That was probably the highest price deal we've had trade in the marketplace this quarter. So Dan, maybe start with you. What have you seen on the investment sales side?
There's only been 2 large trades in the market. since the pandemic started up. The Amazon trade you just mentioned that Van Trust built, 855,000 square foot building bought by a Los Angeles-based private equity company called Pralock. They paid $127 a square foot, which is a very strong number for a building of that size. And they bought it at a 4.57 cap rate. So right at a record cap rate. But in spite of COVID, you know, there's a handful of tenants that you'd love to have. And I'd have to think right now, Amazon is at or near the top of the list. So that's a unique situation, but still it speaks volumes about the market and about the faith that a lot of people still have in the market. Brookfield also sold about 450,000 square feet to Lincoln. That was their first acquisition in the market after being gone for over 25 years. Lincoln paid $172 a foot after about a 7% retrade. And that was about a 4.8 cap, very, very low yield going in for vintage product. But Garrett Toss tells me there was quite a bit of growth in the rent roll. And they're already kind of hitting those marks on renewals and new leasing of any vacancies they might have. I have a small trade going right now with a San Diego-based client. Kathy Jones just sold a kind of what I call a covered land play in North Las Vegas, a 12-acre site that Amazon coincidentally has leased for truck storage. So you're going to continue to see probably small and mid-sized deals get done, what I call have-to deals, primarily trades. The reason you won't see much from the true capital market side is because as soon as this pandemic started, it was an instantaneous separation between sellers and buyers. Whether you had a deal in escrow like we had several, the buyer calls up and said, okay, where's my discount? We have a pandemic, and the seller's like, hey, I still have my rent roll intact. It's the same property you were engaged on 20 days ago. Why am I giving you a discount? And a lot of buyers walk from those type deals. So we still have that separation. The difference is there's a number of groups putting together these kind of value add funds that are going to hope to be able to buy distressed opportunities in Vegas, whether they're lender type situations or just owners who don't want to wait out the cycle. The difference we have, in addition to what Ryan talked about with regard to an entirely different, what I'll call educated lending environment, because they learned an enormous amount from the way everything was handled in the GFC. You don't rush in and take the property back, and because you then got to figure out where all the bones are buried. You're better off keeping the operator in place and trying to work things through. In addition, the ownership profile in Vegas is substantially stronger and more well-heeled than we had 10 years ago. So much more institutional ownership, lower debt profile, less mom and pops in the development game with new projects completing. So I think an ownership group as a whole is in a much better situation to handle this downturn than we've ever seen in Vegas. And that's just going to continue to shape the future of Vegas. We're going to continue to have fewer larger owners in town of industrial real estate. But by and large, we're kind of done with investment deals for the near term until we're able to bridge this gap, which means one of two things. Either sellers start to come down and are willing to attract these value add buyers, or the market starts to shore up and we plug some of these holes that are becoming more visible, and we're able to get back to historical pricing.
Do you see either of those two factors starting to, is there a trend in either direction at this point, or are we stuck in the middle and not moving towards either?
Really, the trend right now is the potential for the value add opportunities to start to appear. And there's different schools of thought. So obviously a vaccine can really change things quickly, right? So part of the question is kind of back to the audience. How soon do you think that'll happen? While I do believe in the herd mentality philosophy, I think that takes an enormous amount of time. If you look at the total numbers of illnesses and compared to the total population, it could take a few years to reach herd immunity. So it's really, something has to happen that we don't know about right now, or we have to find a vaccine. And we're probably going to be dealing with viruses for the end of eternity. So I think we're going to see some value add opportunities. There's just no way around it. Again, it's going to be with kind of the bottom 20% of the ownership profile. The people who weren't super backed up coming into this situation. Maybe they got a little overextended on the project to begin with. Maybe their lenders has a little more teeth in their project than should have happened. So kind of depends on a project by project basis. But you can't ignore the fact that the industrial market is faring a lot better than most people think. And I do think Vegas is going to continue to attract a lot of companies from other markets. And I can't stress enough the number of reach outs we're getting from California for a variety of reasons, a lot of which comes from their governor, the way he's handling the pandemic. I really hope that our governor does not act in the same fashion. I think it's going to be a painful process, but if we shut down the hotels again, or we shut down the restaurants that are already at really low occupancies on a daily basis, if you go out and have lunch or dinner, to some extent, we have to fight through this, and we have to keep things open, and we have to do all of the responsible things we're supposed to be doing to keep the numbers down.
Agreed. I'm supposed to turn it over to Q&A soon, but I really would love to hear Ryan's take on investment sales in the market and what he's seeing. So Ryan, if you could expand on that for a second, and anything else you'd like to cover, and then we will hop to getting into Q&A. And if anybody else has any questions that they want to throw in, now is your time to throw them in. So please submit those now.
I mean, I think investment sales from an office perspective in terms of traditional, we haven't really seen too much in terms of, cap rate investment sales during COVID. Saw some, Southwest Gas, they closed on a big building during COVID for their campus. They closed on 5 acres to the south of that building for their campus. They've got over 150,000 feet of new building now for a new campus. So I think that I'm a little surprised at the comment that, within another month or so, there's going to be a big wave of like defaults, because I really didn't think that there were that many borrowers out there that were that leveraged to that point where 60, 90 days of half rents would collapse them. And I hope that's not the case. I don't see it there personally. I think like Dan said, I think a lot of people I think a lot of those relationships got very vested between borrower and lender. And I don't think anyone wants those buildings back. And I think they will work through it if that even becomes the case. But I still am leery if that becomes the case. I think from an office perspective, most of us, we work on laptops and things. So for our perspective, a lot of work can get done from home right now. And so we haven't seen a tremendous amount of layoffs. I don't think, from a traditional office perspective, and I think that all plays into the investment world. But right now, the investment talks that I'm having with people are more about those with the money are looking for the discount. Those that have the assets are saying the same thing Dan's landlord said. Wait a second, 20 days ago, you had this in escrow. My rent roll is still the same. The tenants are still paying the rent. Other than COVID, why am I discounting the building? So I do think that there's a huge disconnect there. And somehow I think the market will actually kind of correct itself, because I do think that there are deals being done. And to the point, there are coupon deals, and then there are the underworkings of the belly of any transaction. Where, and that there's a lot of ways to dissect transactions. So I do think that we're going to get more and more creative on the investment side, but I do think that the investment side is going to have a hiccup here for a minute until they figure out which direction they're going in terms of cap rates, cost of value of money, And really, I think the investment world is really watching who their tenants are and are those tenants paying rent. To Dan's point, Amazon would be a great one for the industrial world. There's a few in the office world that are great, and then there's a few that scare a lot of people away. So that's, I think the short answer is I think we're kind of a little sluggish on the capital investment market. We saw some great activity leading up to this year and right at the beginning of this year with Moonwater and a few others, but that's about it.
One thing, before we get to Q&A, one thing I would throw out as it relates to the whole default conversation, according to Real Capital Analytics, in the 4 years preceding this crisis, if we will call it that, the debt composition in the commercial real estate market across the country was roughly 15% CMBS loans. And the reason I bring that up, they are traditionally more rigid when it comes to a default circumstance than are maybe your typical national, regional, local banks. And in the run up to the Great Recession, CMBS loans were the predominant lending source. And so potentially we have a circumstance here where the banks are much more in the driver's seat. And like, you know, you both have said, the relationship between bank borrower and landowner is much more congenial, could be much more congenial, and could avoid this kind of disposition phase where you're dealing with a lot more distress. So with all that said, I wish we could talk forever because this time has just flown by, but we need to turn it over to Q&A. So I'd like to introduce Mariana Honeycutt, who we all know and love, and she's going to start peppering us with some questions from the audience.
Thanks, Owen, and Ryan and Dan, thanks so much for the great conversation here. We have nearly 300 participants today, and if you look at the bottom of your screen, I believe you can access the poll results. Oh, looks like we've got them pulled up here. So, you know, we had 3 questions this morning for the audience. Where are you working from mostly, and how have your shopping habits changed, and are you willing to get on an airplane between now and the end of the year for either work or leisure? And looking at these results, if you guys could both provide your initial feedback to this, I think the audience would be really interested in hearing that.
I'll just chime in on the work versus home. I think it would, I mean, when we did the dry run, I think it was 75% of us were working at work. I think this would be higher at work if it weren't at 7:30 in the morning.
You know, I'm surprised to see the number of 71% of people who took this poll said that they would hop on a plane for work or leisure between now and the end of 2020. And I've actually hopped on a plane back in early June. The virus had seemed to been a little bit lower key at that juncture than it is today, but it was an interesting experience, and I felt safe. I felt comfortable. I don't know if how I would feel about a completely packed wall-to-wall plane, but you know, I would be comfortable on Southwest flying again with nobody in the middle seat and some separation.
Great, thank you. So I'm going to start this first question from the audience here. It's for Dan. Dan, what will drive growth in Las Vegas for the industrial product over the next 12 to 24 months? What do you foresee?
Logistics is probably going to take the lion's share of that. So there's a number of kind of disruptions and changes that are occurring as a result of this pandemic. And I'll give you a really simple example. Think about in mid to late March when you went into a grocery store and the shelves started to empty out. First of all, it was one of the scariest things I've seen in my life. I didn't know how to react to it. Yet the restaurants were closed and there was mass spoilage of a lot of consumables, dairy items, meat. So the logistical pattern had no way to adjust between filling the shelves of a grocery store from the product that was going into the restaurants. That's all being looked at and modified right now. And with that, you will not only see a change, but you'll see an increase in occupancy as a result of these suppliers creating dynamics where they can shift supply chains from A to B and B to A and other items. Think about the increase of online sales. I don't remember the stat, Mariana, you just put up, but we're buying a lot more online right now. And we never really stopped going to the grocery store. Just if we can get it online and we can wait a day or two or four, we're doing it. So inventory levels across the board are going to increase. You're also seeing a big change in what's called just-in-time delivery patterns, where you go on the internet and you order something, or you go to RC Willey and you order something, and that ships directly from the manufacturer to you. It never goes in the retail store. That is going to have to shift because we ran out of so many items during this pandemic. So you're going to see retailers, you're already seeing retailers, including groups like Kroger, bulk up inventory levels so that they have excess capacity and they can't rely on just-in-time shipments. I already touched on the density factor, and that's a really important component for Vegas because a lot of the groups are calling us are for markets where we've never spoken to anyone in. And that includes New York City. You're seeing groups try to get themselves and those companies out of dense environments into more suburban environments, which pretty much all of our industrial market, every submarket is in a suburban market. North Las Vegas, Henderson, even the Southwest is a little ways off the strip. So that's going to help provide benefit. The quicker we get back on track, and I think I saw a question on conventions, it's going to be a big indicator of how deep this gets on the hurt side. If we start seeing these conventions in September, October, November happen, we're gonna drive occupancies up. We will assist gaming revenues, and we will start bringing many more people to Vegas who spend money. And it's important to note that the casino operators are the second largest group of occupiers in our 142 million square foot industrial base. They only got eclipsed in the last 18 months by logistical fulfillment companies like Amazon's and Sephora's and Bed Bath & Beyond and those types, because that group has exploded so much and probably will continue to do so. But the second largest group of occupiers by SIC code is the convention industry. So if those shows don't happen, we're gonna be in for some hurt.
Thanks, Dan. Yeah, you answered a couple questions there that we had come in, so great response. Next question here is for Ryan. Ryan, you had mentioned no compression on sales prices and lease rates, but this audience member had mentioned that they're seeing several strong proposals asking for significant concessions and reductions in office. In your opinion, is this just a natural ask, or that will not truly affect the market? What are your thoughts on that?
I think, yeah, that's a great question. I mean, to Dan's point, I think that every deal, has its concession package. I think the coupon rate is what we were referring to at the time. I haven't seen a lot of compression on that coupon or asking rate. In terms of on sales prices, I haven't seen us come off sales prices either. We do get offers that are low, and I'm not sure if those deals are being made. I've gotten a lot of lowball offers or just unrealistic offers, but they don't seem to be making. That's my opinion on. I mean, I think that tenant improvements is probably the biggest concession that's being negotiated outside of the free rent element. And again, those are all kind of stand on their own a little bit, depending on where the development is, where the project's at, how long's it been sitting on the market. 10 months free rent on an industrial deal that's just now, not even finished construction is probably a great deal in the underwriting, makes total sense. So I think that, we are seeing what, the notorious turnkey TI by landlords, and that's always the big bogey. I think that for the most part, most landlords still kind of achieve close to their asking rents. And in some way, yeah, the effective deal will get naturally whittled down, but that, I think it's more predicated on the TI packages and the free rent than the overall asking prices.
Thanks, Ryan. Question back for Dan here that came in. Dan, you had mentioned distressed funds forming. Will the buying opportunities be realized or will the buying opportunities that are expected be realized?
So if you'd have asked me that question 3 weeks ago, I would have said no. And today I'm really starting to wonder, again, it all comes back to the unknown. How long is this situation going to drag out? Do the Southern Nevada or state of Nevada numbers continue to spike? How do we end up faring at the end of the year and very early 2021 on conventions? Does the government or does the governor do the right thing and forge ahead? Or does he kind of take what some people are calling the easy route and shut things down again? Crippling effect on the Vegas economy. We will survive what happened before. I don't know that I want to think about what would happen if he did that again. So there's a lot of unknowns out there, and we take as much information in as we can, but it's a challenging time for anybody.
I kind of want to jump in on that too. I mean, I've talked about a couple different servicers I've talked to, and they're not even sure what they're going to do with a lot of these properties just yet, and that have come into special servicing. And so when we talk about what sort of value add opportunities may exist, we're largely, from what I hear in the marketplace, it's largely going to be hospitality and retail properties. And maybe some of that is, adaptive reuse of retail properties for new projects. Maybe it's, a spot industrial project to accommodate last mile, or maybe it's, going to be scraped and it's going to be apartments from now on. But I think to Dan's point, nobody really knows. Even the people who are supposed to know, should know, don't know. And it's a big question mark for all of us. So if anybody out there in the audience knows, tell us. We need to know.
Thank you. So this next question is for both Ryan and Dan. Have either of you heard that lenders are lowering their LTV and requiring escrow accounts that have at least 12 months of operating expenses deposited? In other words, is it going to be more challenging for investors to obtain financing?
I think the answer is going to be yes. They're going to be more critical, but I haven't heard the other one about a 12-month escrow of operating expenses. That's something new to me. But I think just the underwriting itself, and if it is a true lease investment and it's a cap rate type scenario, I think there's going to be a lot of scrutiny towards the types of tenants in the buildings nowadays, and their overall modeling and what they do in that space and how that could affect rents. I'll turn it over to you, Dan.
I'll answer it two ways. On the owner user side, kind of more SBA type stuff, I don't think we've seen a change. There's more skepticism. The buyers are a little more wary, but people are still buying owner user opportunities, and I think it makes a lot of sense. Interest rates are so low. There's a lot of money out there for occupiers to buy their own building, and we're finally offering larger buildings that can be bought as big as 200,000 square feet. That's never happened in this market. On the investment side, there's probably the biggest change I've seen is the scrutiny or the quality of the rent roll. So they're not just looking at occupancy of the property and operating statements. They're going into the individual tenants and saying, okay, 30% of your rent roll is convention related, 20% is hotel related. We need to kind of talk to these companies. So there is going to be more looking under the covers with regard to the quality of the rent roll. but I have not heard any ramp up with regard to reserves or anything of that nature. But again, we haven't done a true sizable investment deal since this started.
I'd echo those things. I've definitely seen deals fall apart because the lender's approved LTV was not where the borrower wanted it to be. I haven't heard anything about the reserves for operating accounts like that, but I think you've got to expect, even to some extent on the owner user side, we're going to be talking for some time about a lot tighter underwriting guidelines, lower LTVs, and just generally a lot more tenant scrutiny, no matter what you're looking at. And it's going to vary, I think, from lender to lender. There's some lenders that may have really tightened up and are hardly looking at anything. And there are other lenders that if they have a strong enough relationship with the borrower, either for investment purposes or for owner user purposes, they're going to go. But I think the one thing that's interesting, and it's not really retail, office, or industrial, but on the apartment side, the government agencies have money and are lending. And so those markets are a lot different, and we're going to probably see in Q3, Q4, some bigger apartment deals trade, whereas in Q2, the biggest one we saw was maybe 15, 20 million. And I think we're going to see a little bit resurgence there just because the liquidity is there in the market, given the agencies.
Oh, and that kind of segued a bit into one of the questions that we had come in here. We had an audience member ask if you could talk about the amount of capital and liquidity in the market right now. What's your observation at the moment?
Well, I'll sum it up like this. I think everybody in the investment world has formed an opportunistic fund and is waiting to see where they can find value add opportunities. There are hundreds of millions of dollars in this community with people that we probably all know who have opportunity money ready to, not opportunity fund money, opportunistic dollars. And so that is there, and I think cash will be king, but they want to, in an ideal world, leverage that money so their buying power is more. And that is hampered a bit at the moment. So, and like we've discussed, those opportunities and the pricing disconnect has not revealed itself at this juncture. So if that happens, and again, I'm just a guy who sits at a desk just like anybody else. I don't know the answers here, but I think if that's going to happen, we're probably looking at 6 to 18 months from now, depending upon the variables of everything that happens, before we're in a pricing situation where that value can be realized. But there is a lot of value on the sidelines, and or a lot of capital on the sidelines waiting for that value.
And I would take it one step further. There's way more than enough liquidity in the market. And it's not just on the value add. There's plenty of core money still out there looking for the right opportunity. Van Trust, in addition to that Amazon building, they also were going to launch a 713,000 square foot building that's occupied by Sephora. No problems with the tenant. We heard yesterday from the guy who runs that plant on the LVPDI conference that they're capturing about 77% of their brick sales via online. So remaining very healthy. I think that Van Trust didn't think it was the right time to be selling a single tenant retail fulfillment center. So that's just going to be postponed. But I think when they launch that, there'll be tons of groups lining up for a core opportunity like that.
I agree. There's a lot of money out there right now.
I'm going to jump in and say something else. I did see one question on the feed about 1031 exchanges, and I do hear a lot about that and people having their exchange money that they want to find a good investment, and even sometimes on well-located retail centers. So that might be interesting to see. But I've also heard, and we discussed this in our kind of pre-session as a group a little bit, I've also heard of some people a little scared of the variables in the market and a willingness to take the tax impact and take what money is left over and have it in reserve for opportunities later on. So we may be seeing that some people actually forego their 1031, their tax deferment, which could seem a little strange to some folks, but that's happening.
All good stuff. Thanks for the great insight there. For the group here, how do you think the eviction moratorium and the rent relief programs are affecting occupancy? We had a member ask, are we just kicking it down the road?
So there's kind of two ways to answer that. First of all, without a doubt, we are kicking the can down the road. What we're doing is we're buying time. But during that time, some of those companies will regain health and they'll continue on. If they're supplying the casinos with food, for example, when that shut off, there was no revenue. Now that we're back, I think I heard somewhere close to 80% of the properties in Southern Nevada are open right now, albeit at lower than historical occupancy levels. Those revenue streams are continuing again. So hopefully for a lot of companies, the buying of time is going to get them back where they need to be to stay in those buildings. For some, if this drags out more, again, back to the conventions occurring at the end of the year, if those don't materialize, we're going to have to extend those programs again. And you're probably going to see that no matter what, because we don't have an immediate end in sight to this situation. So that's, again, some of the fluid stuff that's going on behind the scenes that we really can't gauge the extent of yet until we have more information.
I want to say, too, that I think that simple, maybe it's not simple, that activity of now dealing with evictions and that sort of thing is going to draw attention away with landlords from thinking about potentially other great opportunities and really digging into what's, where am I going to go next? They're in triage mode at the moment and not necessarily looking to acquire more. Maybe some are, but it's definitely a triage mode that takes a lot of time.
Well, great. Well, we have just barely skimmed the surface of all these questions that are continuing to come in. So I really appreciate your feedback. What I'd like to end on before handing it back over to Julie is this final question, since this is a broker panel after all. What can vendors, contractors, designers, membership, what can we all be doing that's most valuable to commercial real estate managers, brokers, investors, in this particular environment right now? What can we be doing to help you?
So I have to get something in before we switch it off. A longtime friend of mine, Michaela Stewart, is moving to London on Sunday. She just graduated college and she's going to grad school. And I've known her since the day she was born. And I would be remiss if I didn't say we will miss you very much. To answer the question, this is two kind of fluffy, meaningless statements that I've developed in the last couple months, but it's really based on what I'm seeing. First of all, show up. And I think that goes without saying with the contractors, because most of them are really busy. But from the other industry types, I'm seeing a lot of people that just can come in the office and they're not. They can be working 6, 5, 8 hours a day, whatever, and I don't think they are. I think a lot of people have been filled with a sense of dread and they're not willing to look for the sunshine. We could be in a lot worse situations. We could be in a lot worse markets than we're in. And even if you don't have a lot to do, get up, get the clothes on. If you're not allowed to come in your office, sit in front of your computer and just call anybody you know and see how they're doing. You will absolutely develop business. If you can come into the office and network with your peers. That's probably the mistake I'm seeing. The biggest mistake I'm seeing people make right now is they're accepting defeat long before they're defeated. And that's what we're trying to do. Show up every day, collaborate with our peers, share information with our competitors and our clients. And if nothing else, just try to get in a better situation when things really start cranking again, because they absolutely will.
I would just echo that. I think there's a lot of positive going on out there in spite of COVID and a couple other big issues surrounding our country. But aside from those major issues, there is a lot going on in our market that is positive. And I agree with Dan. I mean, if you read the paper yesterday, we didn't even touch on this, but 40-acre development, medical campus down in Henderson, next to the Raiders Stadium. I mean, there's a lot going on in this town, and I think as long as we focus on the positive, half full, not half empty, we're going to be just fine.
I'm going to just piggyback on what you both said, and this has been especially looking back a few months, it has been a distressing time. And we've seen, if you're a broker or you're in my business, the title business, we've seen a lot of deals fly off the table, and that can be distressing. We've heard about businesses close, people getting let go, and it is a tough time. But we as a community it's important for us to stay connected. That's what we do as human beings, is we stay connected, we talk to one another, and that's when we thrive. And this has been so troubling because we have to be separate from one another. But we have this, we have our phones. I joke as a salesperson, all my other tools have been taken away. My only weapon, my only spear is my phone. And so, I joked with the group the other day, smile and dial, and, stay connected to your friends, your clients, your family. And, I think the rest is going to fall into place.
Excellent. Well, Owen, Ryan, Dan, thank you so much. It's been a pleasure to hear from you this morning. We appreciate your perspective. And with that, we're going to hand it back off to Julie.
Thank you all.
Thank you.
Thanks.
Thanks again, Mariana and Dan, Ryan, and Owen, as well as our breakfast meeting sponsor, Commercial Alliance Las Vegas, and all of you for participating in our virtual breakfast meeting. Thank you. Please take a moment to take the survey after today's program, and we'll see you on August 20th at our next breakfast meeting. Until then, be safe and be well.